Welcome to the Daily Update Podcast, where I'll go over the action in the market for Wednesday, November 26th, and we'll see how things look for Friday, November 28th. The overall tone of the market remains cautiously optimistic. The S&P 500 closed up 0.69% at approximately the 6813 level, crossing 6,800 in the morning session before settling just above the key R1 pivot point at 6808. Wednesday's advance was rather broad-based. Finally, tech and semiconductors participated more meaningfully, which had been a slightly missing piece in recent sessions. Volume, as expected on a pre-holiday Wednesday, was extremely light. No meaningful selling took place into the close, just a quiet drifting that remained higher. Importantly, the S&P 500 is positive on the short, intermediate, and long-term time frames, and price has now reclaimed the critical 6,800 level with gamma support underneath. There were several encouraging developments. The markets are pricing in a rate cut for December, which continues to firm up each day. The 10-year Treasury yield has slipped slightly below 4%, lifting rate-sensitive sectors. This could help real estate, utilities, financials, small caps, and mid caps, which all posted gains. Breadth is improving. The advanced decline line is rising, new highs are expanding, and the smart money indicators are all positive. We're also watching a potential, though still unconfirmed, ZWAG NYSE breadth thrust that, if validated by December 5th, would be a powerful bullish signal. The fear gauges that we watch are retreating, with the VIX back below 20, the daily put-call ratio declined, and gamma exposure is giving positive readings. We also have year-end seasonality that remains favorable. However, as always, there are yellow flags and concerns. Leadership remains rather narrow and more defensive. Value continues to outperform growth on a relative basis, and the growth-to-value ratio, along with discretionary to staples, is threatening a death cross if improvements don't happen soon. Approximately 35% of S&P 500 stocks are still in individual bear markets, being down more than 20% from their 52-week highs. There's still an active confirmed Hindenburg omen generated back on October 10th, and short and intermediate term momentum in mega cap growth and tech is still mixed to negative. Looking over the economic data, the economic calendar was mostly constructive. Initial jobless claims came in weaker than expected, which is positive. Durable goods rose greater than expected. And the only soft spot was the Chicago PMI, which came in quite lower than expected. Late in the day, the Beige Book offered no dramatic surprises. Overall, the macro backdrop continues to show growth moving higher while inflation is trending lower, exactly what risk assets want to see. Looking ahead to Friday, November 28th. Friday will be a half-day session with options expiration in play and light volume expected. Seasonality for the day after Thanksgiving is mixed to slightly negative, so we would not be surprised to see a choppy, range-bound price action day. Any significant move will likely lack conviction unless something surprising happens. In conclusion, we are positive on all time frames, and the S&P is repairing the recent technical damage, but the rally leadership is still defensive. Until we see growth decisively outperform value, particularly after the holiday weekend, aggressive long exposure should remain measured. Thank you very much, and I will talk to you in the next podcast.